now let's talk to Ian. Good morning, Ian.
Hi, James.
Thank you very much for doing this again. It's well over a year, I think, since we last talked to you, but so we're quite keen to see what you've been up to. I think what we're going to do is talk about the fund first and what you're trying to do here and how it works, please. If I can find it.
There you go. It's that one there. Yeah, brilliant.
Yeah.
Okay. Morning, everyone. Let me give you literally a 60-second introduction. So, Temple Bar is an investment trust that's been around amazingly for nearly 100 years. I think in a couple of years' time we're going to have our 100th year anniversary. It is, I think, it's reasonably well known for being a UK-focused value investment trust. It was previously run by a chap called Al Mundy, who I'm sure a lot of you would know, and then it was taken over by myself and my co-manager, who's called Nick Purvis, in October 2020. A little bit of background to us for those of you who don't know us. So Nick and I have been running money for about 35 years. So we've got lots of grey hairs and lots of experience. We've been running money together since 2007. As I say, we've been running Temple Bar since 2020. And we are probably best known for our slavish devotion to value investing. So let's jump into the slides here. First question: why do Nick and I believe in value investing? Well, we believe in value investing because we think there's an awful lot of evidence that shows that in the long run it works. And I know immediately a lot of people will be thinking, well, it hasn't worked recently. But this, what you've got in front of you here, is a very long-term study looking at which factors work in the stock market. And what you can see here is ones on the left basically have added value over and above the market return. So value does, momentum does. Interestingly, quality doesn't, and growth certainly doesn't. And I know a lot of people will find that surprising because things like quality and growth have worked recently. But actually, if you think about it logically, they shouldn't deliver an excess return. Do you think you should get paid an excess return to buy stocks that everybody else loves, to buy safe stocks that that everyone loves? That would be a really odd world. I can tell you why value investing works, because we get paid to buy stocks that everyone else hates. So let's go on to the next slide, James. I think this is also fascinating. So this is value versus growth by decade. Couple of interesting things to note here. So we've got 11 decades here. Value has beaten growth in 9 out of the 11 decades. What I also think is interesting is that if you look at the 2 decades in which actually growth did better than value, a lot of similarities between them. The roaring 1920s, followed by the Wall Street crash and the Great Depression. And I suppose you could call it the roaring 2010s, when all of a sudden central bankers discovered that put the joys of putting interest rates to zero and printing lots of money and basically setting off a series of asset bubbles. And we know how that typically ends. So, in the long run, again, more evidence that value is a better strategy than growth in the very long run, despite what we might have seen just recently. Go on to the next one, James. And to maybe bring this from the theoretical to the real, these are the returns of Temple Bar since Nick and I took over. And in actual fact, I've updated these this morning, so I can actually give you some more up-to-date numbers than this. Despite the fact that outwardly it would have appeared to have been a tough year, actually we're doing okay again. So year to date, Temple Bar is up nearly 10%. Versus a market of 4.5%. So actually, double the market return. And since inception, Temple Bar, so basically since myself and Nick took it over in October 2020, up 87% versus the market of 45%. So again, nearly double the market return and a very healthy absolute return. Another figure which I'll throw out there, and I think this really will blow people's minds, is that of course we all hear, don't we, about how the UK market is a rubbishy market to be investing in, and you should just be holding the mighty S&P 500, Well, since we took Temple Bar over, you would have, as I said earlier on, you would have made 87% in Temple Bar. What would you have made in the S&P 500? This is if you're a UK investor. So this is in sterling, 45%. So you've got nearly double the return in a rubbishy old UK value investment trust that you would have got in the mighty S&P 500, which I think is quite an interesting fact. Go on to the next one. This is just a long run performance chart. I suppose we're trying to prove here that actually Nick and I have quite a long run record. So we've run this mandate for a big UK wealth manager since 2000. And Nick and I used to work at Schroders, and we moved from Schroders to RWC in 2010. And the wealth manager actually moved it across. So it is a genuine, unbroken 22-year track record. And again, you can see we've delivered about 405% versus 197 for the market over that period. So value doesn't just work in theory; it appears to work for in practice as well. Next slide. I'm going to canter through these two quite quickly because again we're sort of entering the realms of theory. But what people often ask us, why do you think value investing works? And value investing basically works because, unfortunately, we're all human beings and we all have these nasty behavioral biases, one of which is extrapolation, overreaction and extrapolation. So very simply, when things are good, we tend to think they're going to stay good. And when they're bad, we tend to think they're going to stay bad. And we certainly do that when we're valuing stocks. The chart that you're looking at here comes from a study in which they basically divided up the S&P 500 by growth rates of the companies concerned in the previous 10 years. And then what you're looking at is the valuation at the end of that 10-year period. So the bar over on the right, that's companies which had grown the fastest, and you're looking at the valuation at the end of that period in price to book terms. And very simply, what this is telling you is that people put the highest valuation on stocks which have grown the fastest, and they put the lowest valuation over on the left-hand side on stocks which have grown the slowest, thereby proving that point about extrapolation. Go to the next slide. So that leads to the question, is that a good thing to do? And what this data here shows is that no, it's not a good thing to do, because as much as we all might, we all might know and love Amazon and Microsoft and all these companies, incredibly, they are the exception, not the rule, because actually there is incredibly little persistence in growth rates. So what this study does, it comes from the same study, and it literally says, okay, we're going to divide the S&P 500 into stocks which grow above and below average. Yeah. So year one, obviously, that's 50-50. 50% grow above average, 50% below average. Then we go to year two, and we say how many of the first 50% which are above average are also in the above average in that year. Yeah. Just look at the bottom line. If that was completely random, it would go 50, 25, 12, 6, 3. Yeah. Now look at the top line, which is persistence of growth rates in revenue, and it goes 50, 25, 14, 9, 6. So there is very, very little evidence that actually many companies do grow at above average rates, and yet that's exactly what investors do. And in a nutshell, that kind of sums up, I guess, why value investing works. Go on to the next one. And in the stock market, it basically creates this. And so the thin green line is the movement of a share price. The thick line in the middle is a schematic of the value of the business. So what we tend to get is that when a business is doing well, investors will do that extrapolation thing that we just looked at, and they basically put high multiples on high earnings, and they end up paying more than the stock is worth. And then they do the opposite at the bottom. So when things are going bad, and that might be for economic reasons, or it might be company specific or industry reasons, people become very, very depressed, and they basically put very, very low value. They value the business as if things are never going to get better again. And that is the opportunity for a value investor. Basically, when people are valuing things significantly below the actual true intrinsic value of the business, that's the opportunity for you. Now, I would say that this sounds logical, and it is logical, but it's certainly not easy. And as demonstrated by the fact that there just aren't that many of us that do this, because it's really, really hard to control your emotions and to go in the opposite way of the rest of the crowd. You're buying businesses which everyone is telling you are rubbish businesses and are, you know, not worth anything and never going to grow again. And psychologically, that's very, very hard to do. But as we've seen in the long run, it does work. Go on to the next one. And I'll just go through this and then maybe we'll pause. There are kind of lots of different reasons why people go through these periods of overreaction. The one over on the left-hand side, I think, is particularly pertinent today, and it's economic cycles. Going into any economic downturn, it is amazing how predictable people's behavior is. What they tend to do is there's a flight out of cyclically orientated businesses and a flight into defensive businesses. And so what people are doing is they're valuing cyclical businesses as if their owners are going to go down and never recover. And, you know, people did that in 2008 during the financial crisis. They did it during the pandemic, and interestingly, they've just done it again for different reasons. But again, that is one opportunity for us as value investors, is basically to buy cyclically orientated companies on the assumption that very few economic cycles just go down and just flatline. You know, they're called cycles for a reason. And then there are other reasons. Capital cycles are a really good one. You know, commodity type businesses tend to go through these boom bust cycles, don't they? And investors do exactly the same thing. So you go back to 2013 when, you know, commodity prices were booming. Investors value those businesses as if those conditions were never going to go away. And of course they do go away, but then they do the opposite at the bottom. You know, they value things as if commodity prices are never going to be improved. So hopefully you get the idea there of, I guess, how we think about things, and particularly how we think about, you know, opportunities.
Good. That's a good introduction.
Indeed. Have you got any questions, James? Or
some questions already.
Yeah, go on.
Just do a couple of them. So cool. Firstly, valuation wise then, so how does the values of stocks you've got in your portfolio compare to those of the typical index stocks?
Well, actually, could I ask you, James, to go down to that top 10 slide?
Yeah.
There you go.
Yeah, cool.
So I said earlier on that Nick and I have run money for 35 years. We have literally never seen a top 10 that looks like this. These valuations, in our mind, just make no sense whatsoever. You know, look, you go down that top 10 and you go 5, 6, 6, 6. These are price earnings ratios: 5, 6, 6, 6, 5, 5. You know, it's just extraordinary. Dividend yields of between sort of 5 and 8%. Not even in the middle of the financial crisis, actually, do I think we saw valuations this low. And the point there is that normally sets you up for a very good period of return. So if you think about when our best period of returns were, they were coming out of TMT, when nobody wanted to own old economy stocks, coming out of the financial crisis, when again people sort of repeated that stampede out of anything that was sort of cyclical or and out of financials, coming out of the pandemic when people did the same, and again we think we're set up now for a pretty strong period. The only thing I'll add to this, James, is that although we're using here 1-year PEs to demonstrate the cheapness of these stocks, when we value a business, we actually try to look 3 to 5 years out, and we try to say to ourselves, where do we think the earnings of that stock can get to on a sort of 3 to 5 year basis? Because going back to my point about overreaction and extrapolation, if you think about it, we're often buying companies whose earnings are at a temporary low point, and we don't want to value them there. We want to value them at a point where we think the earnings have recovered, because we think eventually the market will value them off that. So let me give you an example there. That third stock down is Marks and Spencer's. They made earnings per share last year, I think, of about 18p. But we think that business has basically got a lot of operational momentum. It's a turnaround story. We think that they'll eventually do earnings of probably 25 to 27p, something like that. So we would use that as the basis on which we value that business.
Okay, that all makes sense. Thank you. Now we're going to jump back, I think, because there's a question here about the valuation gap between the UK and the US, and,
Yeah.
and that's the first chunk of the slides that you put in the deck. So
Yes.
let's go back and do that now, I think, because that's
Yes. I think this is.
I thought it was interesting.
I think this is really fascinating.
Okay.
Okay. So the gist of this is, I think the US market is stratospherically overvalued, and I'm just dismayed by the fact that so many people are currently selling UK equities to go chasing, selling UK equities to go chasing expensive US equities. The first chart here, it's come from a US fund manager called John Hussman, and what he's done is he's basically back tested all of the different valuation ratios, and this is the one which he has found most correlates with subsequent returns, and it's effectively a sort of market cap to GDP type measure. The point on this chart goes back to the 1940s, but actually you can take it back to 1900. The US market today is more expensive than it was at the peak in 2008, the peak in 1999, and the peak in 1929. Which just blows my mind. And I think, as we all know, it's now something like 70% of MSCI World. So a lot of people have got 70% of their equity exposure because they use these market cap weightings in a market which literally has never been more expensive, bar a few months in 2021. Go to the next one. And we'll sometimes get the pushback. Oh yeah, Ian, but it's only the tech stocks that are expensive. Actually, the rest of the market is okay, and it's not. So what we've done here is we've divided the market up into 10 deciles of valuation using price to sales. So that top line is the most expensive stocks, and the bottom line is the cheapest stocks. All I would ask you to do is look at that bottom line and compare where we are today with where we were in 2008 or where we were in 1999. We're more expensive today, even on the cheapest stocks in the US market, than we were on both of those parts. Go on to the next one. Again, this just blows my mind. So what we've got is using that same sort of market cap to GDP, which was found to have the strongest correlation with subsequent returns. This is literally what he's doing here. So across the bottom, you've got that valuation in history. And then on the y-axis, you've got the subsequent returns that you've got in the following 12 years. And you just can see the most amazing negative correlation there, or to put it into simple English. At times that you paid very high valuations, at times you were paying sort of 2, 3, 4 times. You actually lost money if you compare those dots to the left-hand side. You lost, say, 2 or 4% per annum for 12 years. Whereas when you bought the market when it was cheap, when it was 0.5, you went on and you made 18% per annum. Now, if you can all see that arrow over on the bottom right-hand side, that's where we are today. So today, the US market is priced to give you, exactly, thank you, James, the price to give you minus 2% per annum for the next 12 years. My guess is that most of you would be reasonably unhappy about that. And of course, it's you probably won't get a nice smooth minus 2%. You'll probably get a drawdown in that period. Go on to the next one. Now just contrast that with this. So this being the UK market. So over on the left-hand side, this is the valuation of the UK market against MSCI World. And note that this is a 50-year chart. So this goes all the way back to 1975. And, people will often say to us, but the UK market should be cheaper than MSCI World because of their sector composition. And actually, we agree with that. Because we've got more financials and energy and commodity companies, we probably should trade at a discount. But that's why we've put that black dotted line across the middle there. So that's the average over the 50-year period. And the average has been 17%. Today, we're trading at a 45% discount. So we're trading at the sort of widest discount that we've been, bar a couple of months in 2020 for 50 years. And the other thing which really, really interests me is over on the right-hand side, what we've done there is we've compared UK sectors to US sectors. And so, again, this is try to get away from this. Well, the US should be more expensive because it's full of tech stocks. the point that we're making here, look at the third bar across. The third bar across is the energy sector. So that is telling you that UK energy stocks on average trade at about a sort of 35% discount to US energy stocks. You know, if I put that into some figures for you, you know, BP and Shell currently trade on a price earnings ratio of about 5 times. Exxon and Chevron trade on 11 times. Now, those are very, very similar businesses. They're global businesses. The future direction of the UK market makes absolutely no odds to those companies at all, because they generate about 5% of their profits from the UK. The fact that they are listed in the UK, however, means you're buying essentially the same stocks at a 50% discount to their US equivalents. Go on to the next one. This is interesting as well. So this comes from another study, and it basically just showed that when you buy markets whose currencies have depreciated and are cheap on a purchasing power parity basis, they tend to outperform in the future, and vice versa. And there's 2 reasons for that. One is because the currencies tend to mean revert. So having bought a cheap currency, you tend to get that benefit. And the more subtle one is the fact that the companies within that country get the benefit of being of having their currency become competitive against other currencies. So there's 2 reasons. And of course, again, this is very pertinent today, isn't it, where we've seen the pound until very recently lose a lot of ground against the US dollar, and certainly I would say currencies such as pounds, yen, and euro all look very cheap on a PPP basis against the US dollar. Next one. I think this is. I'll probably finish this section here. The final thing that we would say gives the UK, and certainly a trust like Temple Bar, an advantage is dividend yield. People used to, people particularly in this country actually, used to really be big believers in the power of compounding dividend yield. And anyone who ever bothers to read the annual Dimpson, Marsh and Staunton study will know lots of evidence that if you buy higher dividend yielding stocks, it produces an excess return in the long run, a very significant one. And we can see here that the UK has a massive advantage over other regions. So the UK market today yields around 4%, the US market around 1.5%. Interestingly, even if you strip out the commodity stocks from the UK market, you've still got around a 4% dividend yield. So the US market has a disadvantage immediately on that basis. It would have to produce a lot of excess growth to be able to make up for that. So I think there are a whole plethora of reasons really why investors should be doing the absolute opposite of what they seem to be doing at the moment. Everyone at the moment seems to be selling the UK to buy the US, and I think they should be doing exactly the opposite.
Great, thank you. There's a question just popped up here where I think you can probably answer quite quickly, but basically saying, aren't markets supposed to be efficient? How can this possibly happen?
Yeah. Yeah, you're right. In theory, they are meant to be efficient. In practice, it never ceases to amaze me how inefficient they are. If you look at just look at share prices over time. One of our favorite examples is the share price of Next. In the financial crisis, went from £28 to £8 in 12 months, and it produced earnings per share at the end of that year of £2. So £8 share price, £2 of earnings. So the market basically put Next onto a price earnings ratio of 4. Now, I can kind of see why people were freaking out about banks during the financial crisis. Why you would think it was necessary to take 70% off the Next share price and put it onto 4 times earnings is kind of beyond me. But it's just amazing demonstration of how people's emotions take over. People, as I said, sort of back at the start, if we were all sort of robotic and computer-like, then markets would be efficient. But we're not. We all suffer from these massive behavioral biases, and it's that drives share prices, way above and way below what seem like reasonable levels. And just to finish that story, by the way,
cool.
So in the following few years, Next goes from £8 to £80.
Exactly. Good. Right.